Welcome back to this class. In this class, we're going to talk about dividend decisions, and types of dividend decisions. What is dividend decision? It is one of the crucial decisions made by the finance manager relating to the payouts to the shareholders. What is payouts? Payout is the proportion of EPS, that is earnings per share, given to the shareholders in the form of dividend. And dividend is the return given on the investments that investors to make. Companies can pay either dividend to the shareholders or retain the earnings within the company. Now, the question is how much of profits are distributed? The amount to be distributed depends on the preference of the shareholders and the investment opportunities prevailing within the firm. Now, let us understand the meaning of dividend. Dividend refers to the return declared to the equity shareholders through the distribution of a portion of profits earned by the organization, or the proportion of revenues paid to the shareholders. The amount to be distributed among the shareholders depends upon the earnings of the firm and is decided by the board of directors. Now, let us look into the types of dividend. We have 6 types of dividends. One is cash dividend, scrip dividend, bond dividend, stock dividend, property dividend, and liquidating dividend. Now let's understand each one of the dividends. What is cash dividend? Cash dividend is one of the most common type of dividend that is paid in cash. The shareholders announce the amount to be distributed among the shareholders on the date of declaration. Then on the date of record, the amount is assigned to the shareholders and finally the payments are made on the date of the payment. The company should have an adequate retained earnings and enough cash balance in order to pay the shareholders in cash. Scrip dividend is another form of dividend where the company issues the transferable promissory notes to shareholders wherein it confirms the payment of dividend on a future date. These types of dividends are issued when a company does not have enough liquidity and requires some time to convert their current assets into cash. Bond dividend are similar to scrip dividend, but the only difference is that they carry longer maturity period and pays interest. The fourth kind of dividend is the stock dividend, or in other words, it is also called as bonus shares. This type of dividends are issued when a company lacks operating cash but still issues the company stock to the shareholders to keep them happy. The shareholders get the additional shares in proportion to the shares already held by them and don't have to pay extra for these bonus shares. Next is the property dividend. These dividends are paid in the form of property rather than in cash. In case a company lacks the operating cash, then non-monetary dividends are paid to the investors. Last but not least, the liquidating dividend. When the board of directors decides to pay back the original capital contributed by the equity shareholders as dividend is what we call it as liquidating dividend. They are usually paid at the time of winding up of the company or winding up of the operations or at the time of the final disclosure. Now coming to the definition of dividend policy. Dividend policy is defined as the dividend distribution guidelines provided by the board of directors of a company. It sets the parameters for delivering returns to the equity shareholders on the capital invested by them in the business. While taking such decisions, the company must maintain a proper balance between its debt and equity composition. Now, coming to the types of dividend policies, we have a stable dividend policy, regular dividend policy, irregular dividend policy, and no dividend policy. Now, let's look into one by one. In a stable dividend policy, the company decides a fixed amount of dividend for the shareholders, which is paid periodically. There is no change in the dividend allowed even if the company incurs loss or generates high profits. Regular dividend policies refers to where a certain percentage of company's profits is allowed as dividends to the shareholders. When the gain is high, the shareholders' earnings will also hike and vice versa. It is one of the most appropriate policy to be adopted for creating goodwill. Irregular dividend policy. Under this changeable policy, the company may or may not pay dividends to the shareholders. The top management, that's the board of directors, solely take all dividend decisions as per their priorities. As the name suggests, the fourth dividend policy is the no dividend policy. The company always retains the profits to fund their future projects. It has no intention of declaring any dividends to the shareholders. This strategy may seem to be beneficial for the business growth, but usually discourages the investors aiming for sustainable income. With this, we come to the end of this session. See you soon in the next session. Thank you.